Hello, I am James Grigor, Senior Portfolio Manager at NZ Funds, with an update on the KiwiSaver inflation strategy. While inflation has remained low for several years, an increase in inflation is one of the biggest risks faced by a long-term investor. Ronald Reagan once described inflation as being as violent as a mugger, as frightening as an armed robber, and as deadly as a hitman. Until recently, central bankers thought that this thug had been locked up for life, but the mugger is back on the prowl. Inflation expectations in the United States is focused on unemployment rate. As the economy approaches full employment, the scarcity of workers puts upward pressure on wages, which companies then pass on in higher prices. The United States jobless rate at 4.1% is the lowest for over 17 years. However, inflation until now has nevertheless been surprisingly weak. This is starting to change. The latest snapshot of United States inflation showed core consumer prices rising 2.1% in March. We are now entering a phase of sustainably higher inflation. This notice has also raised the spectre that the United States Federal Reserve may need to raise interest rates more quickly than the market expects. So how are New Zealand funds positioned within the inflation category? The portfolios within the inflation category invest in a combination of shares and low-duration fixed interest instruments. The split between the two asset classes is currently 70% shares and 30% fixed interest. Shares tend to be inflation sensitive. However, it is important to identify sectors of the economy that are particularly inflation resistant. Typically, investing in companies with real assets and sectors of the economy that are stable and in some cases indispensable and at different economic phases are viewed as particularly inflation resistant. These real assets include many types of commodity investments, real estate, and monopolistic infrastructure. At the same time, we look for fixed interest instruments or bonds that have a shorter term to maturity and/or bonds that pay a variable rate of interest that benefit from rising interest rates. The inflation category is well positioned for any sudden or protracted increase in inflation. At the same time, it will continue to benefit from the positive environment in the global equity market that we believe will continue in 2018. Thank you for watching. We look forward to talking to you again next month, and for more information, go to nzfunds.co.nz.